Ladies and gentlemen, good afternoon. Thank you for this invitation. I will talk about financial sector reform, governance reform, and ask what has been accomplished, what are the leftovers. I'm obliged to mention that the views I'm going to express are exclusively my own and do not necessarily correspond to those of my employer, the Austrian Central Bank, and the Euro system. It was exactly 10 years ago, in August 2007, when the global financial crisis swept across the globe. In the months up to the Lehman collapse, there were no substantial reform initiatives in Europe, because in Europe there was this general view that the crisis was a problem of the United States, and Europe would be well equipped to withstand and would be resilient enough to withstand the shocks. It was only after the collapse of Lehman that a substantial reform process has started at the level of the G20. And the promise then was to do everything to avoid a repetition of the past. The parallels between Europe in the 30s and Europe today, they are striking, stark and increasingly frightening. These words have been written 5 years ago, but I think they are today even more relevant, and the recent election outcomes shouldn't be cause for complacency. Among progressive economists, there is a consensus view on the economic mechanisms that have pushed so forcefully the euro area in stagnation, in balance sheet recessions. These are front-loaded fiscal consolidation, the simultaneous deleveraging process of several economic sectors, as well as the deep design flaws of the Eurozone that are in the process of being fixed. Considering monetary policy, well, the general view is monetary policy was decisive to avoid deflation and a deep depression. It was decisive in stabilizing the Eurozone. But in general, I think what has happened is the outcome was to avoid the worst. But this is a modest outcome, given our historical knowledge about the disastrous political consequences deep financial crises usually entail. So I will focus on what has happened with financial sector reform since the crisis. Did we return to status quo ante, as some? I mean, if you do a survey among the population, I think there's this general perception that concerning the functions of the financial system, nothing substantially has changed. But I will also ask a more normative question, which was raised by Benjamin Friedman, Harvard professor, in 2009, who was asking how is the financial system performing its jobs? Does finance serving society in terms of equity, efficiency, and economic growth? And just my conclusions will be as follows. First, I think regulatory reform has been substantial, but it has been partial too, and which is a major concern for supervisors and for policymakers today, is that risks have migrated from the banking sector to shadow banking activities, towards shadow banking actors, shadow banking entities. And finally, concerning, the governance reform of finance, banking union, the single resolution mechanism, bail-in, I think these were very, very important reforms, but they did come quite late. And if elements of a banking union, for instance, would have been established already immediately after the outbreak of the crisis, the consequences, the disruptions would have been much less severe. Today, 10 years after the crisis, the banks are still digesting some of the legacies of the crisis. There are some countries where the banks have still high non-performing loans. And I'd like first to answer the question, why were the European banks so heavily affected by the crisis? At the height of the crisis, we have learned, also economists were astonished, that less than 1/3 of the size of the balance sheet are loans to the households and the firms. Less than 1/3 of the deposits are deposits by non-banks. So the rest was wholesale funding. What's the problem with wholesale funding? I mean, the European banks finance their expansion strategies with scaling up this kind of funding sources. These are interbank, these are funds from the money market, but they are also funds from the so-called repurchase market. Repo market has become very important. It tripled in size between 2002 and 2008, and the sovereign debt instruments are the most important collateral. So in the repo market, banks are borrowing cash against collateral. And the problem with the wholesale market is that it's inherently fragile. It's prone to be faced with sudden stops. It's a short-term refinancing instrument. And unrecognized by the general public, but also by many policymakers, the European banking system has undergone a fundamental transformation process towards the development of a liquid, highly securitized market, similar to the United States. I mean, for instance, the repo market at the height of the crisis had a similar size as that of the United States. The second reason why Europe was so heavily affected by the crisis is, again, unrecognized also by many economists, that large European banks were round-tripping across the Atlantic. So what does it mean? The US banks were providing the funds to the European banks that again invested those funds in best-rated so-called safe assets, asset-backed securities, mortgage-backed securities, etc. And this round-tripping is well visible in the capital accounts balance sheets of the United States. Here you see indicated or marked with the red circle that in parallel to an increase in cross-capital inflows, you see a similar increase in cross-capital outflows. So this is the round-tripping. A final cause of why European banks were so heavily affected is that the European banks did not only add to the financing of the housing boom in the United States, but they also financed the unsustainable boom in the periphery countries. This was mentioned at several occasions already today. But you see here the blue bars, they indicate the exposure, the claims of the banks in the core countries vis-à-vis the periphery countries. And you see here that these have increased a lot. And here we see that those banks funded the boom in the south, but I mean, the architects of the monetary union, they were envisaging kind of catching up process of it's an increasing real divergence with free capital movements in order to make up for. I mean, some of them knew that the euro area did not fulfill the criteria for the optimum currency area. So many argued, well, then we, let's say, free up the free flows of capital. But what's interesting here is that the unsustainable boom, the rising capital in the current deficits, and also the let's say rise in wages above productivity growth, this was very much caused by the malfunctioning of the banking system. And this is important. It doesn't have to do much with, let's say, unresponsible behavior from the side of the trade unions, for instance. And what the banks also did, and insurance companies, is that they invested heavily in the sovereign debt market, which helped to equalize the spread across the countries. And then when the crisis hit, we see here, starting in 2010, a sudden stop event. So the crisis had nothing to do with a sovereign debt crisis, which is the usual narrative. It was a balance of payments crisis. and only the ECB, so the whatever it takes stance of Mario Draghi, and the setup of safety nets across Europe was helping to stabilize those capital outflows. Second, the design features of the euro area with respect to the role of the banks. I think one very, very eminent factor that explains very much of the regulatory failures we have seen in the years up to the crisis is the fact that globalized banks, were supervised at the national level. So the European banks, again unrecognized by many, have more or less evolved as financial conglomerates with opaque organizational structures operating in multiple jurisdictions. And this has, and the very complex intermediation chains has overwhelmed the capacities of national supervisors. And national supervisors, they were engaging in kind of regulatory arbitrage. They were regulatory captured, but they were also captured by the knowledge base, as we all know. And many of the national supervisors, they saw their role not so much in setting strict rules, but also in acting or in allowing regulatory forbearance in order to, let's say, improve the competitive advantage of the national banking system vis-à-vis its peers. The second design failure, which is also related to banks, not only to the sovereigns, is this famous point made by De Grauwe and G, where they argue, we have a sovereign debt market where 19 individual countries are issuing sovereign debt instruments, but those sovereign debt instruments are not backed up by their central banks. So they are more or less issuing instruments, issuing government bonds in a currency they don't control of. And this has a vast amount of implications. First of all, the sovereign credit of the weaker countries is, is more exposed to the risk of, let's say, liquidity run, to self-fulfilling defaults. But through the bank sovereign nexus, this has also implications for the banks, because also the banks of a so-called weaker member state are more exposed to the risk of bank runs and the lack of a common deposit insurance at the European level, and this is particularly harmful at the current situation. And this point was very often made in the past, which pointed towards design failures that so far haven't been fixed. Another one is a design failure which is not that well known, the shadow fiscal nexus. This was coined by Daniela Gabor. It points to the fact that the repurchase market is organized in a way that it is collateralized with sovereign debt. So we know, for instance, at the height of this of the so-called of the euro crisis, important systemic repo players like a clearinghouse was all of a sudden no longer accepting government bonds as collateral. And this has exacerbated the sudden stops, the capital outflows of the countries. And we have other characteristics, for instance, regarding to credit derivatives which have exacerbated the crisis. And this is very fundamental, and I bring this up because I think the banking union, for instance, doesn't know much to fix for this kind of fix this kind of nexus. Well, now I will give a brief overview on what has been accomplished so far, with a special focus on the governance reform alongside with regulatory reform. Here, this is a general overview. As I mentioned already in autumn 2008, the G20 have started reform initiative, and almost all of those reforms, they have been worked off. Europe started late in comparison to the United States with regulating credit rating agencies, hedge funds, securitization was regulated, as well as remuneration. But I don't have the time to go into the details, but I think it can easily be argued that those kind of regulations were modest kinds of regulations. For instance, it allowed for instance, the regulating credit rating agencies, it still allowed those agencies to play a very destabilizing role during the euro crisis. The heart of the regulatory reform was the implementation of Basel III. So banks in general have to hold more capital, which is risk weight, much more capital, and we can see that banks are more resilient today. They hold more capital, much more capital, with high quality in comparison to the pre-crisis years. But still, capitalization is still something, where not all has been accomplished. Another issue is systemically important financial institutions. I mean, the regulatory response to large, complex, interconnected banks was to increase capital surcharges, to impose capital surcharges, and I think there is this famous regulators paradox that large firms need very little capital in good times, but they cannot have enough when there is a severe crisis. So there are many who are arguing that imposing capital surcharges is not enough. You have to go much further, like the US did with the Volcker rule, etc. But I will come to that later. Europe, well, yes, let me just mention derivatives. I think also the regulation on derivatives was a rather modest one. What was happening was that derivatives previously, they were just traded, or most of them were traded over the counter, and they were forced to migrate to so-called central counterparty platforms, and a huge amount of data are now collected. So it's more or less this efficiency criterion of transparency, which is fulfilled now. Central counterparty platforms are now too big to fail entities. But still, we haven't, because the original, let's say, discussion was only allow derivatives if the cost-benefit analysis is conducted, and if those derivatives are capable of being of any benefit to society. Europe has learned the lessons that in addition to regulatory reform, there is a strong need for reforming the supervisory architecture following the recommendations of the De La Rosière report. Supervisory authorities have been set up in 2011, but they didn't have much power, and only after the outbreak of the so-called euro crisis, there was the strong will to go into the direction of a central supervision of the large banks at the European level at the ECB. To many, it seems that the banking union is something that was born as an outcome of the crisis, but the idea of a central supervision at the national level was already here very early. I think in one of the early drafts of the Treaty of Maastricht, there was a stipulation that European banks, given their high degree of globalization, of internationalization, should be supervised at the central level, but at that time, this proposal faced too many vetoes. So the banking union was meant to serve various goals. The first one is, of course, to break this famous sovereign bank nexus, which really is it's a big problem in some of the countries, because it's leading to ongoing fragmentation. Fragmentation could be reduced also due to the policy initiatives of the European Central Bank, whatever it takes, QE, etc. But still, it is there, it's a problem. It should minimize safe haven flows, always in times of stress. So this sovereign bond market regularly, whenever there is some kind of political event, is faced with stress. It should minimize regulatory capture at the national level, which is a very important goal, and it should avoid bailouts It should avoid bailouts with the bail-in instrument. Well, the single supervision mechanism was implemented in 2014 in November. The ECB is now supervising 129 very large banks, which make up 85% of the whole balance sheet. And the second pillar is the single resolution mechanism, which means that banks should be resolved without threatening the sound part of the bank, or without threatening the payment activities of the bank. What's not mentioned here is that this single resolution mechanism, which came into place in early 2016, is also supplemented with a single resolution fund, which is funded by contributions by the bank. But one criticism is that this fund only makes up 55 billion euro. In 2024, there's no fiscal backstop. And the problem is also that the size of the balance sheet in the European Union is about 30 trillion. So there's this criticism that this fund is very small. Another very important new element, which was very often demanded by the civil society, is the possibility to bail in shareholders and unsecured creditors. The goal was to avoid taxpayers' money. We know that between 2008 and 2014, 5% of the rise in GDP is due to can be attributed to direct recapitalization of banks. The problem with this bail-in instrument, I don't want to allude to the Italian experience, but the problem is it's very, let's say, efficient if you want to tackle a kind of idiosyncratic shock, if a bank is faced with an idiosyncratic shock. But if there is a system-wide banking crisis, large-scale bail-in procedures might lead to contagion because of this interconnectedness. And finally, I think this has already been mentioned, the common deposit insurance guarantee scheme would be a very important stabilizing mechanism of the banking union, but unfortunately there's no political consensus on this, because the argument is it's involved with risk sharing among states. Well, another initiative in Europe is the Capital Markets Union. I don't want to go into detail, but I'd like to sketch out some few very important elements. The European Commission has initiated this initiative in order to diversify the sources of funding of firms, also to de-risk banks, because the argument is, and to help small and medium-sized economies, the argument is large firms are capable of taping the bond market. Small and medium-sized banks are still, firms are still faced with credit-constrained banks. Well, I don't want to comment that, but the problem is, it's very unclear whether those aims can be achieved or accomplished, because one important part of Capital Markets Union is the effort, the endeavor to revive securitization. And there are some who are very critical because they are arguing, well, by strengthening those shadow banking activities, securitization of large banks, this might result in financial instability and might even jeopardize the goal of de-risking banks. I think, apart from financial stability considerations, I think the main focus of capital market integration shouldn't be the private one. There are many arguments which can be brought forward against it. I think the main focus should be on integrating the public capital markets. There are several proposals. The Five Presidents report has outlined or sketched out the idea of a euro area treasury that issues euro bonds, but there is also a proposal which doesn't involve mutualization of risk among countries. This is the so-called the SB proposal, which was made by Brunnermeier and others, the European Safe Bonds issue, which might, let's say, it should be an important element of the banking union, at least from my point of view. So just to conclude, to give an overall assessment, I think much has been accomplished, but for instance, the original goal of the G20, which meant to extend regulation and oversight to all systemically important financial institutions, instruments, and markets, couldn't be achieved. I think this is a general concern also by the ECB, that the focus on regulation was too much on banks, so risks migrated somewhere else. There's also this issue that, and I'm always wondering that, for instance, when I look at the Capital Markets Union, the European Commission seems to have high confidence in the efficiency of capital markets and the capital market properties. And there are some who fear that furthering capital market activities, shadow banking activity, might jeopardize the goals of the banking union, which is to protect taxpayers' money. Finally, too big to fail, I already mentioned the regulatory response was to impose capital surcharges. In the Liikanen report, there was made very important argument in favor of intervening in the structure of banks, which says, well, it's very difficult to resolve a large, systemically important, interconnected bank over the weekend. In autumn 2006, I think it was the European Union President Sarkozy and many others, they were mentioning, well, the time of financial capitalism is over, we will build a new Bretton Woods. Actually, we haven't seen anything of this kind. On finance serving society, again, also, there is not much. I think the fact that the financial transaction tax could not be implemented is the Waterloo of civil society. And there are many other issues. For instance, one could use the regulatory framework, the risk weighting, for promoting investment, let's say, some long-term investment or investment which have benefits to society by lowering the risk weights on these investments, just to give a few examples. And we still have financialization of commodities, etc., etc. So the immediate challenges ahead for the sustainability of the euro area is the completion of the banking union. Deposit insurance is not in place. There are many other critical issues regarding the resolution mechanism. I also think that the banking union does little to, let's say, fix this problem, which was brought up by De Grauwe, that we have that the sovereign bond markets are inherently fragile in the sense that they are prone to speculative attacks. And the monetary union was actually meant to avoid speculative attacks against currencies. Finally, I think regulating shadow bank activities, not only entities, but activities, is crucial to avoid a further crisis to happen. And finally, unfortunately, there is a proposal of the European Commission on the table since 2014, similar to the Volcker rule in the United States, to restrict proprietary trading. and there's no political compromise on that. So the general conclusion is much has been accomplished, but there are many leftovers, and I think the main problem was that only the worst has been avoided, but many of the promises that were made in autumn 2008 and later were not fulfilled. Thank you.